As November begins, there are some reasons for investors to be upbeat. The S&P 500 gained around 8% in October after dropping more than 9% in September as a result of some respectable earnings from well-known blue-chip businesses. However, due to significant price hikes that businesses are passing along to already strapped consumers, those earnings were far from ideal. Even worse, even though certain equities are still holding on, the problems in big tech have persisted to show that we have come a long way from the risk-on days of earlier years. It seems naive to just go back to the same practices of investing on Wall Street, despite evidence of change. So if you're looking to make a trade in November, here are some tactical ETFs to consider that may be tailor-made for the upcoming weeks and months. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 10. Simplify Interest Rate Hedge ETF. PFIX, one of the best performing ETFs on Wall Street, has increased by about 100% so far this year because to a tactic that generates gains when interest rates rise. The U.S. Federal Reserve has raised rates 6 times this year, sending benchmark interest rates soaring from almost zero to start the year up to approximately 4% at the moment, with the possibility of further increases in the future. The fund holds interest rate options designed to provide direct upside to this trend. While this tendency has hurt other assets quite a bit, PFIX has continued to perform well and has served as a haven from the demands of rising rates. Number 9. Invesco DB US Dollar Index Bullish Fund. This Invesco fund outperforms the preceding ETF that benefits from rising rates while the US dollar is strengthening versus other currencies. For example, UUP is tied to futures contracts that compare the dollar to the euro, Japanese yen, British pound, Canadian dollar, Swedish krona, and Swiss franc, 6 of the most important foreign currencies. Additionally, these currency futures do well when the US dollar is strong. This Invesco ETF is up more than 15% on the year and is setting new 52-week highs because of the relative strength of America in a volatile economic climate and its interest rate increases, which further stabilize our currency. Additionally, it doesn't appear as though that tendency will reverse anytime soon. Number 8. Energy Select Sector SPDR Fund. Energy stocks surged in the beginning of the year as a result of supply difficulties caused by the Russian invasion of Ukraine, but this summer, as crude oil prices fell from their highs, most of the high flyers from early 2022 collapsed. The XLE fund has recently surged back to levels close to its earlier highs, signaling that the energy industry has made a significant comeback. This is one of the most well-known and liquid ETFs available to play the energy sector, with more than $40 billion in assets under management. And as we approach 2023, things are looking bright for this fund with oil returning at around $90 per barrel. Number 7. iShares MSCI Brazil ETF. Brazil's economy was in ruins a few years ago due to political scandals and COVID-19's aftereffects. However, the country's recession ended in 2021, and Brazil's economy is now gradually returning to normal. Additionally, due to the global commodity inflation, this resource-rich country exports a lot of raw commodities that are more valuable. Investors that are looking beyond the disruptions of 2022 to the future may wish to build out a long-term position in this ETF because Brazil has the largest economy in Latin America and is the most likely to gain from any lasting recovery in the global economy. While the rest of Wall Street has suffered, EWZ has gained significantly since January 1st with double-digit gains. Number 6. Invesco S&P 500 High Dividend Low Volatility ETF. SPHD is a terrific choice if you are more interested in simply hunkering down to survive the upheaval than in placing a clever short-term bet. The fund's name suggests that it combines the high dividend potential of blue-chip firms with a low volatility methodology designed to keep your portfolio strong even during a downturn. The portfolio is made up of stocks like the telecom giant AT&T and the cigarette giant Altria Group Inc. Although they may not be as dynamic as tech stocks during a bull market, the SPHD's components will offer the stability that many investors are seeking right now. The fund also pays a generous dividend of 4.3%. Number 5. Vanguard Short-Term Corporate Bond ETF. Of course, if stability and yield are what you're looking, look at this Vanguard bond fund, which yields 5.4% when you look at its most recent distribution history but only yields 1.8% on a trailing basis. Furthermore, VCSH is incredibly stable as a result of its portfolio's 2,200 short-term loans, which provide income for the company. This includes bonds issued by companies that are almost assured to make their debt payments on time, such as software giant Microsoft Corp. and megabank JP Morgan Chase & Company. To be clear, when the stock market is booming and there is a risk on bull market, bond funds typically underperform. Additionally, when interest rates are rising, bond funds frequently experience losses. Although VCSH's short duration shields it from some of the volatility risk associated with other bond funds with longer durations, the risks are still important to be aware of. Number 4. ProShares Short S&P 500. It's important to note that you don't have to restrict yourself to assets that go up if you want to make money. If you're extremely bearish and need a hedge, or if you're just extremely aggressive and seeking a short-term swing trade. This well-known inverse fund is intended to perform contrary to the S&P 500. So far this year, SHISH has increased by roughly 16% while the S&P has gone in the opposite way by almost the same amount. Currently, SHISH is one of the most well-liked strategies for investors to protect their portfolio from decreases with assets of close to $4 billion. If the bull market resumes, it is obvious that this fund is a lousy investment, but with the ongoing difficulties facing the largest stocks on Wall Street, some downside protection in November may make sense. Number 3. First Trust Nasdaq Oil and Gas ETF. The Nasdaq U.S. Smart Oil and Gas Index, which offers exposure to the U.S. oil and gas business, is what the First Trust Nasdaq Oil and Gas ETF aims to track while making investments. As of September 30th, the total net assets exceeded $1 billion, and the expense ratio was 0.60%. The portfolio of First Trust Nasdaq Oil and Gas ETF includes 40 stocks. Occidental Petroleum Corporation, an American business that buys, explores, and develops oil and gas properties in the United States, the Middle East, Africa, and Latin America, is one of the top holdings of First Trust Nasdaq Oil and Gas ETF. Berkshire Hathaway, owned by Warren Buffett, is the largest shareholder in Occidental Petroleum Corporation, holding nearly 20% of the total stock. Number 2. Invesco DWA Small Cap Momentum ETF. Invesco DWA Small Cap Momentum ETF, which tracks the performance of the Dorsey Wright Small Cap Technical Leaders Index, is another noteworthy ETF for novices. The expense ratio for the fund, which concentrates on small cap companies, was 0.60%. Invesco DWA Small Cap Momentum ETF had 201 equities in its portfolio as of September 30th. One of the top holdings of the Invesco DWA Small Cap Momentum ETF is the Pennsylvania-based producer and exporter of bituminous coal, CONSOL Energy Inc. Following the impressive Q2 results, B. Riley analyst Lucas Pipes increased the price target for CONSOL Energy Inc. to $79 from $63 on August 8 while maintaining a buy rating for the stock. Number 1. Global X Conscious Companies ETF. The Consinity Conscious Companies Index is the benchmark that the Global X Conscious Companies ETF aims to follow in terms of performance and investment results. Investors get exposed to well-managed businesses with favorable environmental, social, and corporate governance traits through the Global X Conscious Companies ETF. As of September 29, the ETF has net assets of $595.58 million and a total cost ratio of 0.43%. ConocoPhillips is an American multinational firm that specializes in the exploration and production of hydrocarbons and is one of the largest equities in the portfolio of the Global X Conscious Companies ETF. ConocoPhillips' price objective was increased to $134 from $123 by Piper Sandler analyst Ryan Todd on September 12, and he maintained the stock's overweight rating, noting the Integrated Oils Group's positive outlook. This is it for today's video. What do you think of our video? Tell us in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.